In this video, I'm going over my top 7 stocks for the month of March 2022. The markets are going crazy right now as a result of the current events, but I've researched hundreds of different companies and this is my list of stocks I think should be on your watch list. I encourage you to watch until the end to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow. Let's get started. So the first stock we are talking about today is Intel, stock ticker INTC. Intel is an American multinational tech corporation known especially for its production and distribution of semiconductor chips and microprocessors. So right now, one share of Intel is trading at $47.38 with a 52-week low of $43.63 and a 52-week high of $68.49. Their one-year price chart shows a gradual decline in price for the past year with a few major bumps along the road. But yeah, back in April of 2021, we did see a high of almost $70 per share. And since then, we are down about 30%. Intel has a market cap of $192.89 billion. They have a P ratio of just 9.75, meaning that they're probably not overpriced right now. They have an earnings per share of $4.86, and they pay a pretty good dividend of 3.13%. And Yahoo Finance marks them as near fair value right now. If we take a look at the valuation measures right now, we can see that they have a 5-year expected PEG ratio of 2.67, and the price to book ratio is 1.92. They have a very healthy profit margin of 25.14%, as well as a very strong return on equity of 22.52%. In the last 12 months, they've seen revenues of about $79 billion. Now, looking at their balance sheet, we can see that they have total cash of $28.41 billion, and they have a very strong current ratio of 2.1. On a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are rating Intel as a 2.9, meaning it is a hold. However, in the last month, we have seen more analysts actually move over to strong buys and buys. The average analyst price target is $54.40, which is about 15% higher than the current price of $47.37. So recently, the House of Representatives passed the China Competition Bill, which permits the allocation of $52 billion to semiconductor companies, including Intel. By funding various semiconductor manufacturing companies like Intel, the US is providing capital and resources for Intel to compete against China's biggest tech companies. And with more money invested in these companies, that's obviously a good sign for companies like Intel. Intel's biggest competitor at the moment is AMD. But the biggest advantage that Intel has over AMD is that Intel makes its own CPUs and semiconductors in-house. In other words, Intel can vertically integrate its business, meaning it can sell its products at lower prices. On the other hand, AMD, who relies on third-party sources and manufacturers to produce its products, is forced to adjust for greater manufacturing costs. This is why many of AMD's newest products are priced over $200. Because Intel can sell its products for cheaper, it can more easily appeal to the lower end of the gaming market, which is definitely a solid competitive advantage to have. This is important to note as Intel reported earnings at the end of January and its numbers were underwhelming to say the least. Besides its revenue, much of Intel's metrics actually experienced significant losses throughout the past year. The biggest reason for these losses was the steep competition that they faced and still face with other semiconductor companies. And yeah, what resulted was an absolute beatdown of Intel's price, which was definitely an unfortunate consequence for the company's shareholders. However, Intel's price has been beaten down so much that some analysts are now considering Intel stock to be at a fair price. And given the fact that Intel will now benefit from government intervention, and of course it does have its advantages over competitors, I do think it's safe to say that Intel is definitely a stock that you guys should be adding to your watch list. So the next stock we are talking about is Expedia, stock ticker EXPE. Expedia is an American online travel company and marketplace that is known for its travel information services and websites. So right now, one share of Expedia is trading at $198.78 with a 52-week low of $136.77 and a 52-week high of $217.72. If we take a look at the one-year price chart, we can see that they were hovering between $140 to $180 per share for most of the last year. In the last month or so, we have seen the biggest upward price movement for Expedia for the last year. They have a market cap of $30.944 billion. One thing I do like is that they have a very low 5-year expected PEG ratio, which is just 1.13 right now. However, their price to book ratio is very high at 15.84. As far as profitability, they have a profit margin of 0.14% and unfortunately a very low return on equity of just 0.4%. In the last 12 months, they've done revenue of about $8.6 billion billion. They're sitting on total cash of $4.31 billion, and they have a current ratio of 0.87. Right now, analysts are rating them as a 2.5, meaning it is between a buy and a hold, and the average analyst price target is $215.96, which is about 7 to 8% higher than the current price of $198.67. So Expedia recently announced its earnings for the fourth fiscal quarter of 2021 at the beginning of February, and impressive would be an understatement. The company's revenue grew nearly 150% year over year to over $2 billion, while its net income grew over 200% year over year to $386 million. And overall, it's evident that almost everything for the company was in the green, which is of course something that investors love to see. But what was the biggest driving force behind the company's ridiculous growth? It's the same driving force that's been bolstering many other stocks lately: lessening pandemic worries and loosening pandemic restrictions. More specifically, Expedia has greatly benefited and is still clearly benefiting from the really big surge in travel. They've made significant profits from travel insurance purchases as well as car rentals. Their lodging revenue has also contributed massively to their growth, and airline ticket sales as well as travel advertising profits have gone up a lot. The thing is though, Expedia has been on quite a bearish run for the past week or two, which is probably due to the hyperinflation of the stock's price due to the insane earnings report. We did see a recent small correction as a result of Russia invading Ukraine, but saw a swift recovery today. I think that Expedia is a worthy long-term pick, which is why I think you should at least place them on your watch list. If you've been watching my channel, you've probably heard me talk about my long-term sponsor, Wealthfront. If you don't already know, Wealthfront is an automated investment platform that I personally use to help my money grow long term. With Wealthfront, my portfolio can benefit from tax loss harvesting, automatic portfolio rebalancing, and recurring deposits. And they have hundreds of investments to choose from that have been hand-vetted by the research team. What I do when investing is continually put money in the market by dollar cost averaging to help reduce risk during times of market volatility while still taking advantage of time in the market. I absolutely love Wealthfront because they help me automate my investments with their recurring deposits so that I don't have any unnecessary stress when it comes to making sure I'm continually investing regardless of what the market is doing. It's really a long-term game, which is why having that accountability and automation is so important. As investing billionaire Ken Fisher once said, time in the market beats timing the market. And that statement has historically shown to be true. Now, if there was one thing I'd tell my younger self when starting investing after college, it'd be to continually invest, use a platform like Wealthfront to make it easy, and sock away as much money as I could afford to invest. So if you want to start automating your investments and build long-term wealth, check out the link in the description and you'll get your first $5,000 managed for free on Wealthfront. And now back to the video. All right, so the third stock we are talking about today is Visa, stock ticker V. They are an American multinational financial services corporation that is best known for their electronic transaction, credit, and debit services. So right now, one share of Visa is trading at $218.48 with a 52-week low of $190.10 and a 52-week high of $252.67. Their one-year price chart shows some pretty big shifts in price, and 1 year ago, they were about $215 a share, jumping all the way to just over $250 a share back in July and August. They sort of cratered down to about $190 a share, and since then we are up about 10% from that bottom. They have a market cap of $470.08 billion, P/E ratio of 36.19, earnings per share of $6.04, and they pay a mild dividend of 0.69%. They have a 5-year expected PEG ratio of 1.64, and they have a price to book ratio of 14.07. Visa is a very profitable company, and their profit margin right now is 51.59%. They also have a very strong return on equity of 35.58%. And this is all in revenues of about $25.5 billion in the last 12 months. Now, their balance sheet shows total cash of $15.92 billion, and they have a pretty good current ratio of 1.39. Now, analysts do absolutely love Visa. They are rating them as a 1.7, meaning it is a buy, and the average analyst price target is $271.20, which is over 20% higher than the current price. So obviously Visa is one of the most well-known fintech companies in the world, and they continue to remain a dominant force in its market. Nonetheless, I'd say that the company still has plenty of room to grow and expand, with a vast majority of transactions around the world still being conducted with cash. For example, parts of the Middle East, many parts of Africa, much of Southeast Asia, and other developing regions across the globe. So that's really why I still think Visa has a lot of room to grow, because there is a much larger world still untapped by the company's electronic financial services. So Visa also has some very interesting developments going on for it right now. Most recently, they began investing up to $100 million to support minority-owned businesses and borrowers. It's a solid PR move, of course. It's a good look for the company, but Visa is also proving its worth in the overall market by bringing value and business to other companies. And because Visa is also supporting lending and borrowing, the market is being boosted by the opening of other businesses as well as other capitalistic ventures. Another recent development is Visa's partnership with Pagaya, which is an AI-powered company that detects credit risk. While this of course offers a greater benefit to Pagaya, I think that this partnership is going to be really good for Visa overall. And it's always worth noting the company's overall durability in the market. Although Visa's success is tied to the overall state of the economy, its growth periods far outweigh and overshadow its loss periods due to its role as an executor of transactions instead of just being a lender or a borrower. Falling interest rates and crashing economies will definitely hurt Visa's business, but they definitely will not cripple this corporation. This explains why the company's most recent earnings report was so strong, even for its size and the number of years it's been in business. They reported over 24% growth in their revenue to about $7 billion and over 26% growth in net income to $3.96 billion. And the biggest thing to consider here is the growth the company experienced in its payments volume and processed transactions, with a 20% and 21% growth respectively. Executing payments and processing transactions is the name of the game for Visa, and to see the corporation's continual growth in these services is definitely a positive and bullish sign for the future prospects of this company. I really do think that they're going to continue growing in the long run, and that's why I think they should definitely be on your watch list. All right, the next stock we're talking about now is Ulta, stock ticker ULTA. Ulta is an American beauty company known for its production of cosmetics, nail products, bath, and other beauty products. So right now, one share of Ulta is trading at $377.38 with a 52-week low of $297.29 and a 52-week high of $422.43. In the last year, we've seen overall a pretty increasing trend in its price with a recent correction at the beginning of 2022. Ulta has a market cap of $20.424 billion, a P/E ratio of 24.19, and an earnings per share of $15.60. They have a 5-year expected PEG ratio of just 0.58, meaning we do expect to see a lot of growth, and they have a price to book ratio of 10.24. The current profit margins are sitting at 10.72%, and they have a very strong return on equity of 45.19%. Their balance sheet shows total cash of $605.05 million, and they have a current ratio of 1.75. Analysts are rating Ulta as a 2.2, meaning it is a buy, and the average analyst price target is $445.32, which is about 20% higher than the current price. Okay, so Ulta Beauty is another example of a highly durable company with a pool of cash, and this cash can and will be used for reinvestment into the company's own businesses. In fact, the company is known for its long history of tremendous growth, as its stock has increased in value by a whopping 1,000% ever since it first came out onto the market back in 2007. Now, the biggest contributors to this remarkable growth by Ulta is its reliable evergreen catalog of products, as well as the emphasis on consistently updating its catalog to match beauty trends and standards of the present day. In fact, recently we saw that Rihanna's Fenty Beauty brand is heading to Ulta on March 6th. And although investors shouldn't expect this update to, absolutely catapult Ulta's sales, the company will certainly benefit from this new addition to their catalog of products. Another test of durability that Ulta has passed with flying colors is its redemption arc following the pandemic. The company has shown very sweet signs of a miraculous turnaround, with Ulta reporting remarkably strong earnings throughout 2021. At one point, the company even reported 3,000% year-over-year growth in both its revenue and net income. Being that Ulta is already one of the largest and most influential players in the beauty and cosmetics market, there's no reason to expect this growth to drastically slow down or come to a halt. Now, something to look out for with this stock is that they are planning on announcing earnings on March 10th. Given the company's stellar earnings reports in the past and high analyst expectations, it's definitely going to be interesting to see what happens. I am pretty bullish on the stock. I think it's a really appealing long-term play, so that's why it's on this list of top stocks. All right, so next up on our list is the Vanguard S&P 500 Growth Index Fund ETF, stock ticker VOOG. This ETF basically tracks all stocks within the growth section of the S&P 500. And right now, one share of VOOG is trading at $262.52, with a 52-week low of $218.97 and a 52-week high of $306.64. We can see that they have net assets of $7.96 billion, an average yield of 0.66%, and unfortunately a year-to-date daily total return of negative 14.55%. So yeah, if you guys haven't noticed, growth stocks have not been performing well through 2022 so far. And of course, the expense ratio, which is one of the most important things I look for in an ETF, is sitting at 0.1%, which is awesome. About 1 year ago, we can see that the price of VOOG was around $230. It increased pretty steadily all the way to over $300 a share back at the end of December. And since then, we have seen that 15% correction. Taking a look at these sector weightings, we can see that they have about 16% in consumer cyclical, 7% in financial services, 3.8% in consumer defensive, 11% in healthcare, 15% in communication services, and 37.39% in technology, by far its biggest sector. We've also got an average PE ratio of 34.98, average price to book ratio of 10.26, and average price to sales ratio of 5.04. Their 1 year daily total return is 10.94%, and the 3-year daily total return is 20.81%. And of course, one reason why I really like to invest in ETFs like this is because the growth historically is a lot more consistent than investing in just one company. Take a look at the annual total return history for VOOG, and you can see that it's done really well over the last decade. So the special part about this ETF focusing on the S&P 500 growth index is that the index itself screens for earnings growth and momentum. So in other words, the stocks in which you are automatically invested in when you buy shares of VOOG, they are filtered based on established positive metrics. Like I mentioned earlier, another great thing to consider is that this ETF has an expense ratio of just 0.1%, which is well below the average expense ratio of 0.41% for most other ETFs, and actually a lot lower than the average expense ratio of similar high growth funds, which of course is great for you as an investor. Now, something noteworthy about VOOG is its performance in the last 5 years. They've delivered returns of well over 120%, which basically means that any investment made in the stock 5 years ago has more than doubled today. If you guys like companies like Microsoft, Google, Amazon, Tesla, and Meta in your portfolio, then you're likely going to really love this ETF. So yeah, I do think that VOOG, it's a great long-term investment, especially if you want to invest in high growth companies with a little bit less risk. All right, next on our list is Upstart, stock ticker UPST. Upstart is a lending platform that's based on AI technology that partners with banks or other financial institutions to issue consumer loans. So right now, one share of Upstart is trading at $132.85, with a 52-week low of $42.51 and a 52-week high of $401.49. So yeah, if you look at the 1 year price chart, it's actually pretty crazy. They skyrocketed from August all the way to around October, November, and then beginning in November, we saw a huge decrease in the price of Upstart. The current market cap is $11.167 billion. They have a P ratio of 92.9 and earnings per share of $1.43. Yahoo Finance is marking them as undervalued right now. If we take a look at the profitability, we see that they have a profit margin of 15.9%, and they also have a really good return on equity of 24.46%. Their balance sheet shows total cash of $986.61 million, and they have a very high current ratio, almost too high, of 12.48. Analysts are rating Upstart as a 2.1, meaning it is a buy, and the average analyst price target is $208, which is about 50% higher than the current price. So to start off, Upstart experienced fantastic growth throughout most of 2021. The revenues jumped every single quarter, ending 2021 on a ridiculously high note of nearly 250% year-over-year growth in revenue and nearly 6,000% year-over-year growth in net income. These figures are insane, and the biggest reason for this growth is simple. Their services were in high demand, especially for the smaller banks of the world who don't have the greatest accessibility to credit information and resources on their clients. So recently, Upstart has brought its platform to various lending markets, including auto lending and personal lending. So there are clearly several markets within the lending industry where Upstart could definitely excel. But more importantly, the company has untapped potential in the home mortgage market, which is valued at well over $1 trillion annually. I think that once expansion is successful, it could easily be Upstart's most valuable sector. The company has already started repurchasing its own shares, which can possibly show the company's willingness to reinvest in itself and its confidence in its own growth and trajectory. And as more and more positive news rolls in about the company's expansion and success, including the fact that Corning Credit Union selected Upstart as its personal lending platform, I do think that it's pretty hard to feel bearish about the stock in the long term. Have we hit a low in the price? I have no idea, but the fact that the stock hit about $400 a share not too long ago shows that, hey, we have a pretty high ceiling. Consumers are gonna continue consuming, money's gonna be borrowed and spent, and so Upstart should have a solid position in the market for the foreseeable future. All right, the next stock we were talking about is Alaska Air, stock ticker ALK. Alaska Air Group is an American airline holding company known for Alaskan Airlines and Horizon Air. So right now, one share of ALK is trading at $57.38 with a 52-week low of $46.26 and a 52-week high of $74.25. We can see that 1 year ago, we were trading around $70 a share. We dropped down to the mid to high 50s, followed by another small correction back in November. And since then, we have seen a positive uptrend in the price. Alaska Air Group has a current market cap of $7.225 billion, P ratio of 15.22, and earnings per share of $3.77. Their valuation measures show a price to book ratio of 1.95. The profit margin right now is at 7.74%, and we have a decent return on equity of 14.08%. They're sitting on total cash of about $3.12 billion, and they have a current ratio of 0.98. Analysts are rating ALK as a 1.8, meaning it is a buy, and the average analyst price target is $72.92, which is over 20% higher than the current price. So overall, analysts are really excited about the stock, and on average, they expect the stock to increase by about 33% over the next year. But what does the company have going for itself to justify such a bullish prediction? For starters, Alaskan Air Group is another company whose earnings have been growing steadily through 2021, with impressive year-over-year growth rates of 135% in revenue and 104% in net income. The company's revenue has seen a steady but substantial uptrend in revenue through the last year, from nearly $800 million to nearly $2 billion by the end of 2021, which is another bullish sign that Alaska Air Group is doing well in the airline industry right now. They've also shown their dedication to bolstering its customer base with the launch of a first ever flight subscription service in the US, where members can earn a given number of flights per year by paying a monthly subscription fee. In a world where subscription-based businesses are taking off in all sectors, I feel like Alaska Air is taking the logical next step in the flight industry as well, with a further emphasis on Boeing's successful aircraft types so far. The company's confidence in the expansion of its own fleet should be another great sign that leads me to think that this is a great stock to watch this month. And there you have it, you guys. Those are my top 7 stocks to watch for the month of March 2022. Given everything that's going on in the world right now, investing right now is pretty volatile. And personally, I'm holding off on buying too many stocks this month. But yeah, overall, dollar cost average, pick long-term winning companies, and you should do fine. If you guys want some free stocks or crypto, I will put links down below. And of course, don't forget to take advantage of Wealthfront's amazing offer where they will manage your first $5,000 for free. I'm not a financial advisor. Don't buy stock just because it's on this video. Instead, I recommend doing at least 1 hour of research per company that you are thinking of buying. Due diligence like that is just really, really important when it comes to investing your own money. Anyways, I hope you guys enjoyed the video, and if you did, make sure to hit that like button and also subscribe for more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thanks so much for your time, and I'll see you in the next video. Peace.